Question 1. How the large-scale war that erupted on 28 February 2026 impact on the stock market performance is highly affected the Russia. Discuss how the war influenced the inventory reaction and market volatility across this country. I will analyze the Russia stock market. First is stock market index. The Russia stock market is reacted positively after the war compared to before the war. The stock index is increased from the low level before the war and to the higher level after the war, which is at 2 March 2026. The lower point was at 2,717.04 on 10 February 2026. However, after the war began on 28 February 2026, the stock market is increased significantly and reached the higher price point of 2,088.68 on the 9 March 2026. So the factor or the reason that caused it increasing is the rising global oil and gas price increased the Russian export revenue and supported the market performance. So that the positive investor sentiment also improved because the stronger energy sector profit. So that show that the Russian stock market is reactive positively after the event. This because Russia is the largest exporter for the oil and the gas country in the world. So that if the price of the energy is increased or is higher, so that the Russia can earn the profit and the revenue due to this situation. The second is the abnormal return. Abnormal return is show the strong fluctuated because of the geopolitical conflict and the sanction pressure on the Russia. The positive abnormal return is occur when the actual return is exceed the expected return is mainly due to the energy demand. Then the negative for the abnormal return is appear during the period of the sanction and political instability from the EU and US. And then this also show that the investor is responding positively to the market performance better than the expected. And the last is the cumulative abnormal return. The cumulative abnormal return is remain the stable before the war, but also have some increases after the war period, which is at 28 February 2026. It show that the Russia is CAR is increased by approximately 2.55% after the war event. The positive for the cumulative abnormal return is indicate improving the investor confidence in Russia's stock market performance and also the higher oil and gas price boost the Russia energy sector and contribute to raising their cumulative abnormal return. And then the geopolitical tension also the one main reason that affect the and affect the Russia return because the sanctions still create fluctuate and uncertainty in the cumulative abnormal return movement. So that we know the stock market is gain the overall benefit during the post-event period. In conclusion, we can say that the Russia stock market is show the positive performance after the war, supported mainly by the higher global energy price and the stronger investor confidence.
For the US stock market, as we know, the United States is a leading global economic power, and it is the largest economy by nominal and is a central hub for international trade and finance. The US is a major producer of oil and agriculture products, and it is also known for the technology sector and financial services. The US is a world largest stock exchange. The largest war that erupted on 28 February 2029 severely affected investor confidence, where it's shifting the market from growth to a risk of defensive posture because of the sudden geopolitical instability. Not the resources exporting nation that benefit from high commodity prices, but the US faced stagflation risk, economic pressure where the combination between fear of the supply chain disruption and a higher for longer interest rate environment triggered the significant volatility and fluctuation. For the stock market index, during the pre-event period, the trend of market price show a strong start, but then show a continuously decline. On 9 February 2026, the market price recorded the higher price in 20XD, which is RM 6,964.82 until it dropped on the 11th. And before the event day, the market was already in a struggling condition where the investor worried about the massive spending on the AI by the big technology company that wasn't show a stable profit. On the event day, a major geopolitical conflict erupted involving the US and Iran. This include joint airstrike and the closure of the Strait of Hormuz, which has affected global oil, as we can see now. During the post-event period after the war, the conflict happened. It sent a shock wave to the energy industry and financial market. This caused to the stagflation fear, where the price goes up, but while economy slow down. From 2 March to 19 March 2026, the stock market price went down continuously from RM 6,881.62 to RM 6,606.49. This showed that investors decide to sell off their stock because higher energy costs give a lower profit for company and higher cost for customer. For the AR abdominal return, the AR show a fluctuates widely between positive and negative movement for both pre-event and post-event period. There are two massive decline before the event days. Where the first decline tells that a pre-shock where the market performed much worse than they expected, likely because of the early news about the rumors of conflict. After that, there is V shape on the 30 February of AR after the massive decline. And the AR remained positive until 18 February before a slight decrease on 19 February. So the second decline is on 23 February. That showed that information leakage or speculation where some investors expected to get a certain of outcome. As you know, before entering the event T, the AR is a negative. So the AR graph showed that the market was surprised. The market performed worse than its normal prediction behavior immediately after the news of the Middle East conflict broke. Compared to the stock market index that show a steady decline after the post event, but in the perspective of AR, the data show something else. Entering the post-event period, the AR show a series of sharp peak and valley. And there is the zigzag pattern, proof that investors were overreaction and underacting as the 2026 conflict and oil price change. This is a common sign of a high uncertainty. And after that, the AR show a jump, and these are likely due to the rely where the investor hope for a quick case fire or diplomatic solution. But there are drop again that tells the reality check where the bad news come from the war front of because of the spike in oil price that given high pressure on the market. At the end, the shock of the event had been fully absorbed in the stock price and the market no longer reached ordinary and the pace of become normal. For the cumulative abnormal return (CAR) before the event days, there is lowest CAR was recorded, which is negative 1.55% on 12 February 2026, and it is a very early reaction in the window, so it's that the US market already showed an underperformance compared to the expectation before the main event happened. This is likely due to the AI software disruption fear and also tech sell-off seen in the mid-February. There is a recovery situation happen from 30 February to 25 February 2026. So this indicates that the market tried to correct itself, and while investors become optimistic again just before the actual event start. At the event day, the market at the event day, the CAR show a positive, and after that there was a small decline in the CAR that showing that the market finally realized that the severity of Operation Epic Fury, the Strait of Iran, will affect as a trading continuous and markets that feel the disruption on oil supply. Continue to the on post event, the graph show a double pattern on CAR where it tells of a massive struggle in the market. So as a conclusion, we can say that the US stock market show a not good performance after the war because there are so many information and so many happen in the global market that disrupt that affect the market to ongoing.
Next, I will explain about the Germany daily stock market price. Okay, before the event, the market was relatively stable with only small fluctuation, showing that there were no major economic shocks during that period. However, after the war started, the market reacted negatively. The daily return dropped significantly and reached the lowest point on 3 March 2026 at around negative 0.0234. This happened because investors became worried about geopolitical uncertainty, rising energy prices, and the possible impact on European economic growth. As a result, many investors sold their stock, causing the market to become more volatile and mostly negative after the event. Next, abnormal return of the German stock market around the war event. Before the event, abnormal return fluctuated near zero, which suggests that investors did not expect the war beforehand. After the war outbreak, abnormal return became significantly negative, with the lowest abnormal return recorded on 3 March 2026 at around negative 0.02911. This shows that investors react immediately to the geopolitical conflict. The market also remained volatile after the event because investors became more cautious due to uncertainties, supply chain disruption, and rising energy price. For the cumulative abnormal return, which measure the overall impact of the war on the German stock market, before the event, cumulative abnormal return remained stable. However, after the war outbreak, cumulative abnormal return declined sharply to around negative 0.03439. Although there was a slight recovery later, the final cumulative abnormal return still remained negative at around negative 0.01056. This indicates that the German stock market did not fully recover within the 14-day event window. Overall, the negative cumulative abnormal return shows prolonged investor pessimism and continued uncertainty in the market after the war event.
For the Poland, based on the graph, Poland's stock market showed a downward trend after the conflict began. Before the war, the market was stable and peaked at 3480.47 on 25th February 2026. However, after the war started, the index experienced a sharp decline and volatility, reaching its lowest point at 2868.99 on 19 March 2026. This happened due to the rising oil import costs, inflation, and geopolitical uncertainty, which reduced the investor confidence and caused a capital outflow. For the abnormal return, based on the abnormal return analysis, Poland market showed a fluctuation even before the conflict, with the higher abnormal return value record at 0.01636 on 25th February 2026. However, after the war began, on 28th February, the abnormal returns become highly violent. A sharp decline was observed between 2 and 3 March 2026, where the value is fell from 0.01125 to negative 0.03371, reflecting rising in investor anxiety, security risk, and inflationary pressure from energy import. Although there were slight recoveries in mid-March, the market remained unstable. The lowest abnormal return was recorded on 19 March 2026. Overall, the negative abnormal returns indicate the Poland stock market performed worse than expected due to the conflict. This largely because Poland is heavily dependent on import energy and has a consumer-driven economy, making it more vulnerable to the cumulative abnormal return, which is CAR. Poland's stock market was relatively stable before the conflict, fluctuating slightly between negative 0.02530 and 0.01573. However, after the war began, the cumulative abnormal return dropped sharply on 3 March 3, 2026. Although there was a temporary recovery between the 4 and 18 March, peaking at 0.10681, this improvement was not sustained. The value fell again on 19 March. Overall, I can say that the short-term recovery could not offset the negative impact of the conflict. In conclusion, the war had a net negative effect on Poland cumulative stock market return.
Hello, my name is Siti BINTI ARPAT and my matching number is 306073. So today, I'm going to explain about the Iranian stock market. The main stock exchange in Iran is the Tehran stock market, which we call is as a TSE, which is the largest and most important stock market in the country. It gives investors access to a market that is rich in natural resources, especially oil and gas, but also highly affected by a geopolitical issue. In early 2026, the Iranian stock market experienced high volatility due to the rising geopolitical tension and international economic sanction. This factor reduced investor and confidence and affected by market stability. Although Iran has a strong energy resource, its stock market is still very sensitive to external factors such as transaction, international conflict, and change in the global oil prices. Because of this, the Tehran Stock Exchange often shows a large market movement whenever there are major geopolitical or energy related to a development. So let's move to the stock market price. Before the war on February 28, 2026, the Iranian stock market showed a positive trend. For example, the stock index increased from around 2,042,150 on February 10 to 2,165,210 on February 26. This shows that investor confidence and market conditions were stable enough before the conflict. However, after the conflict between Iran and America began, the market performance dropped drastically starting from March 1, 2026. The stock market index was recorded at zero because several exchanges, including the Tehran Stock Exchange, were temporarily closed due to the geopolitical tension and financial disruption. Although the global prices increased during the conflict, Iran could not fully benefit because of the international sanction and restriction on oil export. As a result, investor confidence and weakened and market risk increased. So next, I'm going to explain about abnormal return. What is abnormal return? Abnormal return measure the difference between actual return and expected return. Positive abnormal returns mean the market performed better than expected, while negative abnormal return show a weaker performance. Before the war, Iran abnormal return show an unstable movement. For example, it decreased from 0.00438 on February 10 to negative 0.00113 on February 15, showing that investor confidence become weaker due to the political uncertainty and rising geopolitical tension. After the conflict started, abnormal return became a zero from March 1, 2026 because the Tehran Stock Exchange was temporarily closed and trading activity were disrupted. Investor panic, military attack, and international sanctions are also worsened the market situation. For cumulative abnormal return or CAR, the value increased slightly from negative 0.00483 to negative 0.00262 before the war, but still remain negative, showing a weak market sentiment. After the conflict, CAR also became zero because the stock market was closed and no trading activity could be recorded.
So next, let's take a look at the impact of geopolitical conflict on Malaysia market. To start, it is important to understand that Bursa Malaysia is our primary stock exchange. So we use the FPM KHAIRUN to track the 30 most liquid companies, which include sectors like Islamic finance and also technology. While it is supported by strong domestic institutions like the ETF and PNB, our market is still very sensitive to the global event and commodity prices. On February 28, 2026, the start of the conflict and the closure of the Strait of Hormuz caused a major shock, moving our market from a stable state into a period of extreme volatility. So next, let's break down the price movement into three phases. The first one is the pre-conflict. The market actually showed resilient at first, peaking at 1,757 thanks to the strong trade and also good performance in tech and plantation. But as the tension rose, the price slipped to 1,716. Second, the crisis. When the hostilities began, it was a black swan event. The index kept down to 1,700 and eventually hit a low of 1,674. This was caused by a high supply chain issue, a high insurance cost, and also the negative sentiment following warning from our Prime Minister. So the third one was a recovery. We saw a rebound to 1,736 because of value buying in energy stock like petroleum chemicals and the hopes for a ceasefire. However, the market is still volatile as it now factors in a long-term war premium. Now, let's take a look at the abnormal return, which show how the market performed compared to what was expected. Before the conflict, we had a peak abnormal return of 1.13%, but just one day before war started, investors start to hedging, leading to a drop of minus 1.33%. The worst point was on the day 6 where we saw a record of abnormal return of minus 3.11% due to a maritime insurance panics that affected our export. We also see a dead cat bounce on day 7 when government-linked company provided liquidity, but the news of the refinery attacks kept the market on a high alert. Finally, the cumulative abnormal return or CAR gives us the big picture of our total economic loss. In just 2 weeks before the event begins, the CAR was up by 2.1%. However, the war destroyed the wealth almost immediately. After the Strait of Hormuz closed, CAR fell to minus 4.86%, eventually hit its lowest point of minus 6.31% on day 11. By day 14, CAR settled at minus 5.65%. This tells us that even though the nominal prices start to stabilize, the structural damage to the investor confidence remains severe, leaving the Malaysian market weaker than it was before the conflict started.
Question 2, which is analyze whether the war had significant impact on the stock performance and rate profile of the selected company. Discuss the possible reason based on their international responses, supply chains, or independently on global market. I will analyze the stock market for the Malayan banking Berhad, which we call that is Malayan banking. First is, based on the stock price analysis, we know that the Maybank stock price was stronger before the war on 28 February 2026. Then the highest stock is at before the war is 12.38. So the Middle East war on 28 February 2026 is created the uncertainty in global financial market and geopolitical risks. So that Maybank has directly affected because of his international exposure and the Asian regional operation. The stock price is remained strong and stable before the war due to the growth 35-year growth strategy. Then it shows that the highest stock price is before war at 24 February 2026, which is 12.38. And then after the war, the stock price is start declining due to the weakness in investor confidence and global economic uncertainty. Then the lower price stock is after the war, which is 13 March 2026, only 11.32 index price at the market. Second is the abnormal return. The abnormal return is measured whether the actual return is higher or lower than the expected return. Maybank has the AR become more volatile after the Middle East war due to the geopolitical uncertainty and rising in the energy cost. And then it's negative, the AR is show that the Maybank is weaker investor confidence and lower the market performance after the war. After the war, the abnormal return became more volatile. There was sharp decrease from the positive to negative return between 11 March and 12 March 2026. This happened because the geopolitical conflict increased the uncertainty in the global financial market and also the energy price, like the oil price and the gas price, and also affected the international activity because Maybank have the uh, international trade or the project is related to other countries, especially for the Asian countries. So, investor confidence weakness for the bank will affected, then they will affect the Maybank return. The third is the cumulative abnormal return. The CAR measures the overall accumulated stock performance over the event period. The CAR for the Maybank is decreased after the war, indicating because of negative investor sentiment and market uncertainty. Then the CAR also show that the geopolitical conflict situation affect the Maybank financial performance and investment return. This because the CAR is recovered slightly. The overall moment show the investor sentiment remain unstable during the post-war period. And then before the war, it showed a severe decrease due to the investor because they in disappointment about the shareholders return plan because the Maybank don't have their exactly details for the plan, so that the investor is not confident with their project of their strategy, so they will reduce their investment in the Maybank. Then third is the standard deviation. Standard deviation is the increase from 0.01299 to 0.01546, indicating the higher stock volatility after the war. This means that the Maybank stock price became more volatile during the post-event period. The larger fluctuation in the daily return reflected the investor uncertainty and concern about economic recession and geopolitical instability. The last is for the beta. The beta is increased from 1.05 to 1.09, showing the Maybank is become more sensitive to market risks after the war. Maybank beta is show that if the beta value higher than 1 is indicated that Maybank became more sensitive and risky compared to the market during the war period. And this show also the geopolitical conflict increase the market risk and affecting the bank sector performance. So we can conclude that the Middle War is significantly affected the Maybank stock market performance, abnormal return, cumulative abnormal return, volatility for the standard deviation, and the beta. So for global uncertainty, rising in the energy price and geopolitical conflict is the weakened investor confidence and increase the financial market risk. However, Maybank remain relatively resilient because of its strong liquidity, regional position, and the risk management strategy.
Next, I will explain about the Nestle Nature's November hype. Before the event, the stock price was relatively stable between 109 and 112 points, with the highest price recorded on 23 February 2026 at around 1012.4 points. However, after the war outbreak, the stock price started to decline and reached the lowest point of around 102.6 points on 9 March 2026. This decline was mainly caused by investor concern over rising energy costs, supply chain disruption, and higher production costs. Even though the stock price decreased, the decline was still gradual, showing Nestle's defensive characteristic as a consumer staples company. For the abnormal return, before the event, abnormal returns were stable and positive, with the highest abnormal return of 0.0252 on 23 February 2026. But after the event, abnormal return became more volatile and mostly negative, with the lowest abnormal return recorded at negative 0.025855 on 9 March 2026. This indicates that investor uncertainty increased after the geopolitical shock. However, some positive abnormal return appear later, showing that Nestle still had resilience due to stable demand for essential products. Last, cumulative abnormal return. Before the event, cumulative abnormal return fluctuate around zero, showing no significant cumulative impacts. But after the event, cumulative abnormal return dropped sharply to around negative 0.0227, indicating short-term shareholder losses. However, cumulative abnormal return gradually recovered and ended at around positive 0.0088, suggesting improving investor confidence and market stabilization. Next, we move to the standard deviation and beta for Nestle Malaysia's Nurul Berhad. The standard deviation increased from 0.00962 before the event to 0.01285 after the event. This shows that stock volatility and investor uncertainty increased after the war outbreak. Meanwhile, the beta value increased slightly from 0.7907 to 0.8325 after the event. Although beta increased, the value remained below 1 in both periods, meaning that Nestle stock was still less sensitive to market movement compared to the overall market. Overall, the increase in standard deviation and beta shows that the geopolitical event increased Nestle short-term risk and volatility.
For Ronghen International Berhad Company (RKI), RKI is a leading investment holding company. The group has established itself as one of the largest integrated manufacturer and exporter of wooden household furniture in Southeast of Asia. RKI is an export-oriented powerhouse with approximately 99% of its products shipped to the international market. For stock market index for RKI, the market index on the pre-event period has been more volatile compared to the post-event. On the 23 January, stock market showed the lowest stock price during 28 day, which is 1.01. From 29 January to 24 February, the stock price started to increase between 1.15 to 1.19. Although there was sign of recovery day by day, the stock price remained below the pre-conflict average. This is suggesting that a lingering short-term impact on investor confidence. On the event day, the stock price showed a significant positive reaction, and there is a higher price of 1.2 was recorded on 27 February and 2 March, and it showed that a strong buying interest as investors were more willing to purchase the stock. Entering the post-event period, the stock price slightly declined significantly. And after that, from 4 March to 12 March 2026, the movement appeared more stable when the stock price is 1.15. This reflects that the normal market sentiment and consistent investor expectation regarding the wood-based manufacturing sector at that time. And until it started to decline again, and RKI was very active in the share buyback throughout January and February 2026. In the late of January and throughout this February, there were multiple announcements coming out. So RKI was trying to stabilize the price against the downward pressure from the market or the coming from conflict that will happen in the market. For the abnormal return (AR), RKI Berhad during the pre-event period, abnormal return started with a negative value, but it is still under control because it continued to increase. There were a sharp positive AR that suggesting that the market was reaction positively to the news and the other obstacle before the main event. After that, there is a deep decline where it reached a negative again, and it showed that the stock was already facing a high up and down before the event day. Immediately before the 28th February, the event day, the AR was slightly positive and moved slightly positive, and it showed that the market calmed down and was in a wait and see mode just before the conflict break. Entering the post-event period, there are a massive drop in AR. As we can see, as you know, the actual return was much lower than what the market expected. This proved that the conflict in the event that had an immediate impact on investor sentiment, mainly because of the reliance too much on the global export and fear of disrupted logistics. There is a maintained movement from March 4 to March 12, where the AR is 0.48%. This result showed that after the initial panic, the market corrected itself as investors realized the initial sell-off might have been an overreaction. And there is also another massive drop that the decline might be due to another shock in the market, even though there is a new announcement regarding shipping costs on export. There is also a recovery, and the graph show a strong positive value at the end, and investors were more confident to buy the stock at the perceive a discount. For cumulative annual return for RKI before the event day, there is a positive CAR. There is a 7.38%. Is the highest CAR recorded on 29 January. This happened maybe because of there was some very positive news in the 2 weeks before the event start. And right before the conflict started, all the previous 2 weeks gain had vanished, and the stock market also was a natural baseline. Entering the post-event period, there is a sudden drop in the AR and the CAR that it showed a clearly downward structural shift in the CAR, indicate that the event day caused a loss in the company valuation that the market did not and immediately move. And from 5 March to 18 March, the line slowly to trend upward and show an increase but still negative. This is a sign of where market absorption is that where the investors start to realize that the drop was too harsh, and there is a massive final drop, but it continually continue to recover again. That the recover show a very sharp recovery. The fact that the CAR returned to approximately zero by the end of day 14 tells that in the long run the stock was resilient. For the standard deviation for RKI, the standard deviation rise from 2.68 to 3.28%, reflecting an increase in the stock volatility and heightened market uncertainty in the post-event period. This slight increase represents that the investor might have been optimistic about the company upcoming earnings, leading to a steady and low risk climb in the stock price before the event began. For beta, the beta show that the value is negative, that the stock move in the opposite direction of the market. This represents that there is an inverse relationship between the daily stock return of RKI Berhad company and the direct market return of FTSE Bursa Malaysia. It moved the opposite direction, where when the market goes up, the RKI company tends to go down, and when the market goes down, the RKI Berhad company tends to go up. And there is a several reason why the beta is negative. The first one, because some investor may move their money to another company when they are scared to face the market crash. And if the investors saw RKI company as a safe place during the event day, its price will rise while the rest of the market will fall. And second, when RKI company deals in a product that become more valuable during the conflict, such as raw materials, security, and essential good, the success will be opposite to the market pressure at that time. And for conclusion, all this analysis can help investor make a decision based on the RKI company stock market return and risk measure of the bank.
Next, for the Pentec Comp Group, based on the market trend, the Pentec Group holding Berhad show a strong and stable performance during the conflict. The price of stay around 64 to 65 ringgit Malaysia before the war, and increased to ringgit Malaysia 0.68 by 9 March. This rise was driven by a higher oil price, increased demand expectation for oil and gas-related product. Overall, Pentec benefits from the energy proxy effect and performed better than overall market during the conflict period. For the abnormal return, the Pentec Group holding Berhad abnormal return was strong before the conflict began, due to a positive energy sector sentiment. After the war began, the returns value become highly volatile and declined sharply, dropping from 0.003 to 3 to negative 0.02684 between 2 and 4 March 2026. Although there were brief recovery, the overall trend remained unstable due to geopolitical tension, supply chain disruption, and raising a shipping cost, which weakened the investor confidence and increased the market uncertainty. Abnormal return analysis. Pentec Group holding remained relatively stable before the conflict. However, between 25 and 26 February 2026, the value or the cumulative abnormal return increased sharply, reflecting a strong positive market momentum. After the war began, the CAR started to decline due to the rising uncertainty in the market. Between the 11 and 13 March 2026, it fell further from negative 0.01818 to negative 0.02276, driven by a concern over the supply chain disruption, higher shipping costs, and geopolitical risk affecting the key shipping routes like a Strait of Hormuz. Towards the end of period, the cumulative abnormal return show a slightly recover on 19 March 2026. Overall, although there was a short-term recovery, the conflict created negative pressure on return, but Pengtech remained relatively resilient due to a strong financial position.
Hi, my name is Nurul BINTI HADI. My metric number is 306020. So I'm covered under the Dialog Group Berhad, which is established in 1984 in Malaysia, the integrated technical services provider in oil, gas, and petrochemical industry. And then this company is listed on Bursa Malaysia main market in 1996 and operate in more than 7 country business operation of Dialog. Okay. Then stock market prices. Dialog stock price fluctuated before the war. The index decreases from 1.63 to 1.58 before rising to 1.76 in February 2026. So the changes in oil prices and investor expectation affected the stock performance. After the conflict, stock prices become more volatile after the war. The index increases from 1.81 to 1.81 to 2.06 before declining again. And then negative daily return, which is negative 0.0437, shows strong selling pressure and the weaker investor confidence. Second one is the abnormal return. So abnormal return fluctuated before the war. So positive abnormal return were recorded on 12 February 2026, which is 0.048, and 19 February 2026, which is 0.029, and then the last one is 24 February 2026 is 0.017. So rising oil prices and investor expectation increased demand for Dialog shares. Negative abnormal return occur due to profit-taking activities by investor. Fluctuation becomes smaller after the war started. So positive abnormal return were recorded on 9 March 2026, which is 0.071, and 19 March 2026, which is 0.068. So all price increases benefit energy company like Dialog. The third one is the cumulative abnormal return. So the cumulative abnormal return value increasing the highest increasing point before war, which is at 0.0732 on 19 February 2026. This continuously increasing after the war until on 16 March 2026, where the value negatively at negative 0.00454. So the lowest point of decreasing is on 17th March 2026 at negative 0.024. However, for the last 14 after war, it started increasing on 19 March 2026 with 0.0153. So this usually because of world oil prices rise. So the oil and gas company are considered to be profitable. In addition, this boosts the investors' confidence. Investors may see Dialog as a stable company and able to take advantage of geopolitical conditions. So even though there are short-term fluctuation, medium-term confidence is still strong. So continue to standard deviation. So before the event, the standard deviation was 0.026741957, indicating relatively stable price movement and lower volatility. So this suggests that investors face less uncertainty and daily return tended to cluster closely around the mean. So after the event, the standard deviation increases to 0.033789463, which is as a clear signal of heightened volatility. So this means the stock daily return become more erratic with the largest swing both upward and downward. So the last one is the beta. So beta before the event, dialog group berhad was 0.590117 to 1. This is shown the sensitivity to market fluctuation. After the event, the beta declined to 0.3374. This means the stock less sensitive and correlated with FTSE Bursa Malaysia. This shift implies that while dialogues group Berhad's volatility increased, its dependence on market-wide movement decreased. The investor holding dialogue share after the event faced greater internal prices fluctuation, but lower exposure to systematic market risk. That's all from me. Thank you.